So we've looked at WACC for a company. Likewise, we've looked at how to calculate WACC for project-specific reasons. And we said that usually the project-specific WACC is the best WACC to use to appraise a project. However, sometimes that WACC might not be available, and you might be able to leverage on the company's WACC. However, terms and conditions apply. So which means there are criteria that have to be fulfilled before you can actually use the company's WACC to calculate or appraise a new project. And we said the first criteria is the fact that the business risk has to be the same. That is, the project has to be operating in the same industry, the same area of business that the company has been operating. Likewise, the financial risk must be the same, which means the capital structure must be the same. The same proportion of debts is the same proportion of, and the same proportion of debt and equity is the same proportion of debt and equity that the project and the company are using. And I'm going to say that again. When I say capital structure is the same, it means that the proportion of debt and proportion of equity in the project funding is the same as that for the company. And if that is the case, we are good to go to adopt the company's WACC for the project. Or maybe the project is also very small, tiny. Then if it's insignificant, you can adopt the company's WACC. However, what about when those risks are different? We said if the business risk is different, remember, if it is the same, we're good. But if it is different, then you have to calculate risk-adjusted WACC, which is what we have been doing all along when we used to de-gear and re-gear. So risk-adjusted WACC must be used to appraise that investment. Yeah, and that is what I was talking about here. However, if it is financial risk that is different, then you need to ask two questions. The difference, is it significant or minor? If it is minor, you can just recalculate WACC, your normal WACC, which means, remember, your normal WACC is proportion of debt times cost of debt after tax, 1 minus T, plus proportion of equity times cost of equity. So cost of equity remains the same, cost of debt remains the same. Just use the new proportion to calculate the WACC. Okay. However, if the difference is major, which is what you're mostly going to be finding in the exams, if the difference is major, then you have to use a method that is called adjusted present value, which is where most of the work today we're going to focus on. We're going to learn how to calculate adjusted present value. This is what you have to use. This part, risk-adjusted WACC, we've done it before. That is when you have to look for a proxy company already operating in that business area. You de-gear the equity beta of that company, then that will give you asset beta. Then you will get back with your own project funding structure to have your equity beta. That beta is now what you eventually use to calculate cost of equity that you adopt in your WACC calculation. And that's what we've learned before. So I'm not going to talk about this again. This is where I want to focus today. Adjusted present value. Yeah, and I'm going to solve a couple of questions to even make the explanation better. So let's focus on APV. How do you calculate APV? APV is just an improvement on present value. Yeah. And what it tries to do is to separate the investment portion of an appraiser. Remember, we're still appraising investment. So this one will separate investment element from the financing element. Such that you are able to appraise any project regardless of the funding structure. And that's one of the advantages of APV. You can use it to appraise any financing structure, whether the structure is changing or whatever, it doesn't bother you, because you can actually appraise an investment separately, and also the financing effect of that investment separately. Yeah, and how do you do this? Let's look at the investment element. What we are saying here is that you value an investment as if it is 100% equity finance. That's your assumption. Therefore, if we want to calculate APV, usually what you want to do is first of all calculate the base case NPV, which is the investment element. So your base case NPV is your investment element, that I mentioned earlier, plus the financing effect. So you're able to separate the financing effect from the investing element of the project. And this is what we'll be looking at. Yeah. So how do you calculate base case NPV? How do you calculate financing effects? We'll break it down into those components now. So remember, the base case NPV is the NPV when you assume that the company is financed 100% equity. So there is no financing effect. Okay. And what that means is that you have to calculate NPV using cost of equity only. And that cost of equity needs to use CAPM with asset beta. Please take note. So which means when you are calculating your cost of equity, you're using cost of equity cost to risk-free rate plus asset beta, not equity beta. That is ungeared beta. Then the normal RM minus RF. So which means at every point in time, you need to use the asset beta that is relevant for that project, for that new business. Please take note, very important. Now, what about the financing effect? The financing effect is also pretty straightforward, and that's why this method is actually preferred over the typical work method. That's an advantage over the work method. Yeah, because the financing effect, all you need to do is to identify the components that are relevant, and here you're talking about the issue cost. So that will be negative impact on NPV, so that will be negative. So issue cost, remember, for both equity and debt, all the financing cost, right? Because that's the financing effect. Also, all the tax reliefs. I need to identify what are the items that will give tax reliefs. The first item will be the issue cost from debt. Remember, the issue cost on equity doesn't have tax effect because that goes into share premium. So only issue cost on debt will have tax benefit. And likewise, there will be tax benefit on interest. Yeah. So all of that will have tax benefit. And likewise, another financing effect is sometimes you have what you call cheap loan. So you need to put the NPV of a cheap loan. You will see it when I solve a question on this topic. Yeah, cheap loan is when you have a loan given to you at a rate that is lower than the market rate. Yeah, and please, anytime you have all those information and you have to calculate present value, you must always use cost of debt. Usually they will tell you that it's the same thing as risk-free rate. Yeah, but if they don't give you cost of debt, use risk-free rate. If they give you risk-free rate and they specifically give you cost of debt, then you can use the cost of debt. But most times, 99% of time, is risk-free rate you'll be using because they won't give you any different cost of debt. Right. So on this side, you're using KE to calculate your discounting. On this side, you're using KD. Please take note. Quickly, I'll just show you something briefly because I know it confuses some students, and I don't want to take assumptions that it's pretty straightforward. And this is the part on this issue cost, because sometimes they give you a question that is also tricky like that, and they want you to calculate the issue cost. Take for instance, if they tell you that initial outlay of an investment is 2 million, and they say the issue cost is 3%. The question is, how much do they need to raise? So, how much fund do they need to raise? And how much is the issue cost? Given that information. I've seen students applying 3% on 2 million and say that is issue cost. That is wrong. Because remember, your issue cost is paid on the money you raise from the market. Please take note, it's always on fund raised. So what it means is that by the time you raise the money and you pay the cost of issue, you must be left with 2 million that you need for your project. So what we are saying is that if the total fund is X, so you have a total fund minus the issue cost. So this is total fund raised. By the time you remove the issue cost, then you have your initial outlay. This is the money you need for the project. So, which means if you want to calculate the fund raised, that's X minus issue cost is 3% of X. So that's 3% of X. And that's equals to the initial outlay that we need, which is 2 million. So which means that 97% of X is equals to 2 million. Then X, which is the money that we need, is 2 million divided by 0.97. Please take note. And you can use calculator to quickly look into that. Let's see what that comes to. So if we do 2 million divided by 0.97, that means we need 2.06 million. And that means if that's what we need, 3% of 2.06 million is our issue cost. So times 0.03, and that gives you 60K. Another way to do it is to say if we raise 2.06 million minus issue cost is equals to the money we need, 2 million. So issue cost is equals to 2.06 minus 2. That is still equals to 60K. So either use this approach or use this approach. What is important is to understand this relationship. Please take note. So you don't think you need to be applying your rate on the initial outlay. That will be wrong. Please take note. That's a trick that you always face in exams. Another concept I'm going to explain as well, which you will need in this kind of question, APV, is you understanding that sometimes you need to prepare what I refer to as amortization schedule or repayment schedule. Some people call it repayment schedule because when you take a loan, the bank will give you repayment schedule, which will show how your cash flow will be. You see your opening loan, the interest you accrued, the repayment you have made, and your closing balance for every period. So let's assume that you have a loan of let's say 400,000. A loan of 400,000. Tenure, let's say 3 years. And the question says that the repayment is a constant amount annually. So which means the same amount is paid annually. What that means is that, please take notes, remember, that is just called annuity cash flow. They won't tell you it's annuity cash flow, they will just tell you that it's a constant amount. So you should know that interpretation is that is an annuity cash flow. Please take note. They will give you the risk-free rate, which is the interest rate on the debt, let's say 10%. Yeah. In this case, if you are asked to prepare the amortization schedule for this, how do you go about it? The first thing you need to know is you have to calculate what your repayment will be. Because your annuity cash flow is your repayment amount. So this is annuity that you want to calculate. That means you want to calculate annuity cash flow. What you need to remember is that your present value of annuity, which you learned in your FM days, is equals to annuity cash flow multiplied by the annuity factor. So which means that the present value of annuity is the value today, which is the loan amount today, and that is 400k. So which means this 400k is equals to the annuity cash flow that you want to calculate. Let's say that is X multiplied by the annuity factor. So you need to go to your annuity table. Under 10% for 3 years, you see that is 2.487. So that means our repayment on annual basis is equal to 400k divided by 2.487. And if you press your calculator, that means the constant cash flow is 160,836. So which means every year this company will pay 160,836, and this 160,836, remember, that includes both principal and interest. Both. Very important. Once you know your repayment on annual basis, everything is easy, because the next thing you have to do is just go prepare your repayment schedule, which is your amortization table. So you have a period as the first table. So you have 3 periods because 3 years. So you have period 1, period 2, period 3. So period 1 will have opening balance of the loan amount. So the opening balance is your 400,000. After the opening balance, you have the interest that is accruing. The interest will be at your 10%. Remember, we're dealing with cash flow on this table. Right, so at 10%, that will be interest of 40 that will accrue. Then after that is a repayment amount, which we already know. And repayment, remember, is the same thing as your annuity cash flow. And we have already calculated that to be 160.8. So, and that is constant every year, 160.8, because it's a constant cash flow. Once you do your repayment, then you can know what your closing balance will be. And your closing balance is definitely equals to your opening plus interest accrued less repayment. So which means for year 1, you're going to close with 279. Your closing for year 1 becomes the opening for year 2. You calculate your interest at 10%. You do your repayment, you're left with 146. And this becomes the opening for year 3, 146. 14.6 interest. If you deduct that from this, you have something almost 0. And that is how amortization schedule works. Because you can have a question where they tell you that repayment is constant. Yeah, the easy one would be a question that says that repayment will be at the end of the tenure. So which means the interest will just be the same, because the interest will not be on the opening balance alone. And if you do interest on opening balance for 3 years, it's constant, 40, 40, 40, because the whole 400 will now be paid at year 3. But some question will be difficult, and they will tell you that repayment of both principal and interest will be done at the constant cash flow every year. So in that case, you need to calculate separately what your interest will be every year. So once you know what your interest will be every year, you can easily calculate the tax benefit. Because tax benefit will be the interest expense at the tax rate. So let's assume that the tax rate is 30%, for instance, e.g. at 30%. Then you need to apply 30% on each interest, right? So if they tell you the tax is paid in the same year, then which means you're going to have 12 year, you're going to have 8.3 year as tax benefit, and you're going to have 4.3 year as tax benefit. So which means you have tax benefit for each year, then you need to get your discount factor, because you need the present value. That's what you need. Because remember, it's NPV you are calculating. Yeah, though it's adjusted MPV, right? So you get your discount factor, you put it here for year 1, year 2, year 3, and you calculate your PV. And I know that is pretty straightforward for you, right? So you get 0.0909 here, you have 0.826, and you have 0.683. Yeah. So at 10%, 0.909, 0.826, and 0.751. So 0.909, 826, and so 0.751. So that's what we need to do. So which means the PV needs to be calculated for each year. So for the first year, 12 times 0.909, that is 10.9. 0.826 by 8.3, 6.9. 4.3 times 0.751, 3.2. Add everything together, 6.9 plus 10.9. That gives PV of 21.0, yeah, so 21. So this will be the tax benefit, as made that we're calculating the tax benefit on interest, which is part of the adjusted PV, this part, interest on tax benefit. So that will be the PV that we'll be using in that case. And sometimes they can tell you that tax is paid in arrears. If tax is paid in arrears, you know that this PV will be different, because it means that this tax benefit of year 1 will be benefited in year 2. So it just come down like this. So the tax benefit will be different, because year 1 tax will not be benefited in year 1. Year 1 tax will be benefited in year 2. Year 2 tax will be benefited in year 3. And year 3 tax will be benefited in year 4. And in that case, our discount factor will be different, because we need to discount to today, right? So which means there's no tax benefit in year 1. So which means the cash flow in year 2 will be discounted at 0.826. And that cash flow in year 3, we will need to use the year 3 discount rate. And that means that will be discounted at a different rate, which will be 0.751. And we now need another another discount factor, yeah, for year 4. And for year 4, if you look at your discounting table, present value table, that is 0.683. And the PV will be different as well. And that's 19. You can see different figures. So this is when tax is paid in arrears. Please take note. By now, you should be comfortable with your discounting and all of that. So those are the little tricks you will see, and you will also learn it when I start solving questions on this. So let's look at a question quickly. Let's look at rounding code.